For the second day in a row, we are seeing gains. That's something stocks haven't done for almost 3 weeks. Traders cite an industry report showing retail sales growing at their fastest pace in 4 years and the expected spillover into earnings season. But will this latest rebound last? Joining us now to talk about that is Larry Kantor. He's the head of research at Barclays Capital. He called the market bottom in March of 2009. So where does he stand now? Larry, welcome to the show. Thanks for joining us. Let me ask you, first of all, about today's rally. I mean, what do you make of it? It looks pretty strong, but obviously we've had a rough couple of months here.
Yeah, it's hard to know why it's going up today. It's sort of struggled to hold on to gains yesterday. I think what's happened is basically that the sell-off we've seen since April, which is more than 15%, has created some value here in a buying opportunity. I think what's critical is how earnings come in over the next couple of weeks. You know, earnings season starts next week. You know, it's interesting. The last time stocks sold off into earnings season was a year ago last summer, and stocks did pretty well during that period. The last couple of times stocks rallied into it and then fell because expectations were so high. I think expectations have been brought down significantly. Profit margins still look great because companies cut costs so much during the recession, and now the economy's growing. Even if it's not growing fast enough to suit people's taste, it's still growing, and you should see very good profits, and you're probably going to see stocks do pretty well over the next couple of weeks.
But Larry, so maybe earnings come in strong this time around, but again, we're going to start focusing on the outlooks and what companies are seeing later in the year, because a lot of questions out there about what kind of economic growth we do get 6 months out, 8 months out. To me, it's a questionable backdrop here.
Yeah, I think you're right. I think, you know, a couple months ago, before the stock market fell, I think a sort of 3.5%, 4% U.S. economy was priced in. That's no longer the case. The numbers have rolled over in the last few weeks. We're getting weaker numbers. We think you're going to see U.S. GDP growth in excess of 3%. If that happens, that should allow any market rally on the back of good earnings to persist. We think that's going to happen. Why? CapEx is clearly better. Actually, capital goods orders, the CapEx numbers look quite strong. The consumer spending is not great after the recession we had, but it looks like it's growing 3%, which is not too shabby.
How does the jobs market play into that? I mean, a 3% or more growth in GDP would be fantastic. That would also mean most economists say we would add jobs at that level, which is obviously what we want to do. How does that play into this? I mean, you say consumer spending is not great. Yeah. Obviously, people are going to be cautious if the jobs market continues to look so weak.
I think you're right. I mean, through April, it looked like a very steady improvement in the employment picture. You know, we were still losing jobs in Q4. We added them in Q1, and that was growing through April. Now we've had a setback the last couple of months. The real question is this just due to the volatility in the data, or are we going to see continued improvement? We're betting on the latter, but I think you've hit the nail right on the head. You ought to see over the next few months resumption of improvement on the payroll side. We have the unemployment rate going down. That should also continue. I think that is critical to keep this thing going.
But why do you think that the resumption of hiring is going to happen, especially when there are companies who've got a lot of cash, but they don't know what's going to come down the pike in terms of potentially higher taxes, again, more regulation, or whether we're going to see a global economic slowdown? I mean, economists, J.P. Morgan, they've been reining in their growth forecasts.
Yeah, I mean, I think it's because they cut so much. I think you're right. There are a lot of uncertainties out there. Everybody's cautious. However, they cut to the bone during the recession, and if anything, went overboard. And you saw the report today on retail sales. You need to produce things. So you're seeing Chrysler take over some of the Fiat. You know, in other words, automakers, for example, are hiring workers again because they don't have enough output.
Right.
So basically,
what if demand slows down and there's no demand? Then you don't have to hire anybody.
As I say, if you see the demand slowing down, then you've got trouble. You yourself cited a retail sales report today that shows that retail sales are stronger than they've been in 4 years. You know, this is the kind of thing. The consumer's doing, again, 3% growth is okay. It's a lot better than what we saw last year and way better than we saw 2 years ago.
Right.
That, because employers cut so many workers just to meet that kind of demand, which is kind of mediocre after the recession we just had, they're going to need to hire more workers. So you're right, though. If demand starts going down again, then we've got problems.
All right, we got to run. Hey, Larry, always good to get some time with you. Larry Kantor over at Barclays.